what we are seeing is a drop in demand, which is going to cause a slowdown in inflation. We are obviously at an inflection point in markets. We've been through a relatively difficult 6 months with some unusual events.
This has been a period of upheaval in the economy. It is not one where we should be expecting stability in prices. The swings that we've had in output, in GDP, have been unprecedented. And these are factors, again, that warrant a bit of caution and patience in the outlook.
While we are being conservative in our growth forecast, we think that there is a greater than average probability that what is going to occur for the remainder of the year is going to be modestly positive. If we take a look at what the Fed did to get us over the pandemic, what they did, and other central banks joined them as well, is just an incredible amount of support through both interest rate reductions and direct payments to consumers. There is no incremental spending taking place now, and there are other constraints on the consumer as well. So with that drop in spending, what we are seeing, therefore, is a drop in demand, which is going to cause a slowdown in inflation.
Our view of inflation is that it's going to retreat slowly, right? And if you think about the forecast, at the peak of 1Q, was 8.5%. By the end of this year, we think headline inflation will be 6.5%. By the end of next year, 3.5%. It's gotten to the point now where we do think that one asset class or the other is going to diverge. And in all likelihood, and unfortunately, it's usually the bond market that's got to do some winning first.
Owning the bonds that we're talking about, given the scenarios that we've laid out, creates two sources of profitability. One is the actual dividend, and the second is the possibility that they will increase in value in the event that the economy slows as we expect that it will. These two things suggest that owning those bonds at this time provides a great portfolio hedge and an opportunity for you to earn a certain amount back associated with what you're going to be dealing with in terms of inflation. We have been emphasizing for some time the need to make sure that your stocks are exposed to parts of the market where durable demand, things that people have to buy, are in your portfolio.
One clear example on an industry sector basis is pharmaceuticals. And we've emphasized this within the healthcare sector, but have it as a deliberate weighting. Pharma, again, has no historical declines during recessions, no sensitivity to the economy, has a 3% global dividend yield with a history of 6% dividend growth rates. In fact, no slowdowns during recession periods. We think about cybersecurity as being the healthcare for the digital economy. It is the essential spending that chief technology officers can't possibly cut and maintain their networks from cyber theft, cyber criminal activity. We see double-digit increases in revenues and earnings for these firms, and yet they've corrected 20%.
Fighting inflation requires you to manage and husband your cash, but we want it to be invested in high-quality, bonds. We've talked about the need to have defensive portfolios and to take a look at a lot of opportunities in the alternative space, in the hedge fund area, private equity area, real estate, late-stage venture capital areas, all of which are going to give us great entry points over the course of the next several years when that money will be put to work.
We will be very much on the look here before long for this peaking in interest rates and future indications of where tech spending will go as an opportunity to take a larger risk in growth shares. I don't think we have to do this immediately, but we won't wait around for earnings to already be recovering from a downturn for us to think that the stock market will look ahead as it always does.